All right, tomorrow we will hear from a pair of Canadian banks as they kick off bank earnings season. Let's bring in Nigel D'Souza, Financial Services Analyst for Veritas. You have a reputation of being cautious on the Canadian banks. You've only got one buy, and that's National Bank. In terms of themes, what are we looking for? It seems like the consensus is worried that we're going to see some uptick in some loan losses and maybe loan loss provisions.
That's right. I think right now there is concern, particularly on the commercial side with commercial real estate. It's very idiosyncratic. That'll be property specific, borrower specific. So we have to really wait and see how that develops across the bank space. And on the consumer side, it's really a reflection of rising debt servicing costs, pressuring households. So those loan losses are going to continue to drift higher. The real question is, how does that develop for the rest of the year? What's the outlook for credit losses in 2024? And 2025, depending on the level of the interest rates and the macroeconomic backdrop.
Let's talk about levers that they could pull on the expense side. And might there be a windfall on the capital markets side, just because markets have been good, though I know IPOs are still not a great thing right now.
Right. So you're right on the expense side. We have seen restructuring charges last quarter in Q4. There's a reduction in headcount for some banks as well. So they are trying to pull the lever they can, which is managing the expense side and trying to deliver positive operating leverage. We think they will this year. I think positive operating leverage is in the cards. But ultimately, there's a lot of factors that banks do not control that's really tied to the macroeconomic environment, the level of interest rates, the strength of the economy, the overall level of inflation, and credit risk. So we have to see how those factors develop as well, but they are managing what they can.
I don't know if you've been reading, but the macroeconomy is great. Everything is awesome. We avoided, a recession, maybe even a soft landing, definitely in the United States. And at least before these headlines started to come in, there was this thinking that the banks are pricing in the worst case scenario. How do you think about that? What they're pricing in versus what you see happening in the economy?
Sure. So I think right now what's reflected in the bank valuations, share prices, is a consensus expectation for a soft landing, both in terms of the economy not slipping into recession and unemployment remaining relatively low. The risk to that expectation is that there's one of two risks. First, there's a risk that inflation could end up being stickier than expected. So they could be right on the economy and on unemployment, but rates may remain elevated and remain high heading into 2025. That's an issue because we have a mortgage wall of renewals in 2025. That's going to weigh on households and the economy. So that's one way that outlook could be wrong. The second is that we could have a hard landing for the economy and for unemployment, and that will result in higher loan losses on the consumer side because unemployment is going up, and higher losses on the commercial side because of a weaker economy and collateral values declining on secured lending. So I don't think those risks right now either of those risks are reflected in the valuations for banks.
And we do have some that have done very well so far in 24, EQB and National Bank, which is the only one you have a buy. Wouldn't those ones be kind of the most exposed to some of those domestic issues that you're talking about? Why are those ones outperforming so much?
Well, if you see where the pockets of stress are at the moment, it's really in the international banking businesses, right? In U.S. banking and in Latin American banking, more of a turnaround story for Scotiabank. But in U.S. banking, you're seeing U.S. office being under pressure. You're also seeing more regulatory headwinds in the U.S., as well as regional banking issues, deposit outflows, higher deposit costs. So all that's weighing on the U.S. banking franchises of banks like RBC, TD, BMO, CIBC. The domestic picture is still one of normalization. It's really the outlook for interest rates next year that will impact credit losses domestically. But I still think on a relative basis, Canadian banking is a higher return, lower risk business franchise than U.S. banking, which is a lower return, higher risk, more financial system instability.
And I wonder if that message lands with investors, because how many times have I had guests that say, I like TD for the U.S. exposure, almost discounting or throwing out anything that's too Canadian.
So the question we ask our clients is, if you like U.S. banking, why not buy a best-in-class bank like JP Morgan and then pair it with a really well-run domestic bank like RBC or National Bank? And I don't see a good reason to own BMO or TD Bank just for U.S. exposure, because you can replicate that with JP Morgan or any other regional bank that you think is really well-run, or any other large systemically important bank in the U.S. that you think is very, very well-run. So we would argue that you don't need to own a Canadian bank to have U.S. banking exposure. Own a Canadian bank to have Canadian banking exposure, and go to the U.S. and the U.S. market for U.S. banking exposure.
It's interesting you threw Royal in there for that Canadian bank exposure. Of course, they're buying HSBC Canada, but City National, to your point, has been something of a disappointment. Now, they blamed what happened with Silicon Valley Bank as kind of derailing their ability to hit their targets, and committed that this, things are going to start to get back on track. Could that be a source of upside surprise for Royal, or are you not really convinced?
It's a turnaround story. I mean, the issue is they've cleaned up the balance sheet, they put more capital into City National, and now they've had a monetary penalty by the OCC, and they also have essentially a consent order, which is equivalent of a cease and desist, where there's regulatory oversight of City National. Wells Fargo had a similar action taken against them in 2018, and it's only recently that it was lifted. So that's 6 years later. So the issue really for City National is it could be a very long road before they get under that regulatory oversight and they turn around the business and clean up the balance sheet and are more profitable. And at that point, if they get there, I think RBC is probably better off divesting and selling City National if they can get a premium to what they put in.
Do you expect that at all?
Well, with the overhang for the U.S. banking sector, with the regulatory uncertainty, with the unrealized losses on the balance sheets for U.S. banks, and then you have the commercial real estate credit risk on top of that, it doesn't make sense for them. Well, I don't think they'll have a buyer above their market price or for their market price short term, but long term, if there's an opportunity to put more of the capital to work in Canada or in capital markets or wealth management, I think they should take it.
Dividend yield, that's a juicy number. Then it is historically 5%. What do you say to investors who are lured by the dividend?
I think you also have to look at payout ratios, right? Not just the dividend yield. And what's important to remember is that National Bank has a payout ratio below 50%. It's the only bank we think will have a payout ratio below 50% this year. Some banks are going to probably push perhaps 60%. So don't just look at the yield, look at the payout ratio. The bank that has the most capacity to increase the dividend is National Bank. And the other banks are going to be more constrained on dividend growth going forward until the earnings picture improves and the outlook for earnings growth is stronger. So look at both the payout ratio and the dividend yield, because if you look in one in isolation, you might not pick the best bank for dividends over the long term.
Nigel,